You write that 8 years after the crisis began, the big six U.S. banks, J.P. Morgan Chase, Citigroup, Wells Fargo, Bank of America, Goldman Sachs, Morgan Stanley, collectively held 43% more deposits, 84% more assets, and triple the amount of cash they held before. The Fed has allowed the biggest banks on Wall Street to essentially double the risk that devastated the system in the financial crash of 2008. What explains why the Fed would put these banks into the position of, as you see it, inevitable failure? Why create the same circumstances, but this time twofold, that were seen as reasons for the financial collapse? Or does the Fed simply not believe that concentration of banking was behind the failure?
The Fed doesn't appear to believe that because the Fed hasn't, throughout any of this process, and this includes the Fed chairs, Ben Bernanke, who was the Fed chair at the beginning of the crisis, Janet Yellen, who was the Fed chair in the middle of this process, and currently now Jerome Powell under Trump, who's the most recent chair of the Fed. None of these people seem to think that breaking up the banks or separating their deposits, i.e. our deposits, from their speculative or more risky activities is necessary. None of them advocate that. Janet Yellen had advocated the idea that the banking system was fine. I was actually at the meeting, the conference that was happening in late 2015, middle 2015, before they started to raise rates or increase a little bit the cost of money, where she said that internally, and it's been said publicly as well. But they refuse to believe that there's a problem, even though the Fed itself has $4.5 trillion of money subsidizing the banking system. That is historic. To put that into perspective, before the financial crisis, there was about 300 billion, which is a small percentage of that, sort of on offer just in case of emergencies, and now it's $4.5 trillion. So that number has just gone completely lopsided, and it is the same throughout the major central banks around the world. All these central bankers, all of these leaders, Mario Draghi in Europe, the European Central Bank head, Kuroda in the Bank of Japan, they don't want to believe that what they have done by conjuring money to help the banking system and by keeping banks, and this is more particularly a U.S. problem, as complex as they are, as integrated with deposits as they are, is a problem. It's bizarre. But then you look back at 2007, and Ben Bernanke, who was the head of the Fed at the time, as the housing crisis was clearly happening, and his banks had clearly taken the mortgage loans at the time and concocted all sorts of bells and whistles around them and sold them throughout the world and lent money to people and companies and banks to buy them, said everything was fine. And this was just sort of a blip. And yet they saw the numbers that were coming into banks. When I worked in banking, throughout the years, it isn't like no one had a clue as to the fact that certain things were going wrong. And what the banks did was say, okay, these loans are going wrong, so what we're going to do is we're going to repackage them and sell them and make money off of them, so we're okay. And whatever happens after that happens. This is still the operational sort of structure that we have. Why they refuse to see this? Because they're in power. It's not their money. It's money they can fabricate. If it's not your money on the line, you tend to be a lot more blind to what could really go wrong.
You write that the largest private banks, including J.P. Morgan, Deutsche Bank, and HSBC, that inhaled this cheap money from the Fed were not required to increase their lending to the mainstream economy as a condition of the availability of that money. Do you think they would have taken the money if they were required to give it to Main Street? Because I'm trying to determine if the Obama plan of giving this cheap money to these banks was something that was meant not to help Main Street. Could have they just said, look, give it to Main Street, and they would have taken the money and Main Street would have been doing better?
That's really an excellent thing. And I wrote that exact policy in a book I put out in 2009. So just as the crisis was really hitting its worst moments, with that exact idea. Like instead of, and this was before trillions of dollars were available, this was just the beginning of what ultimately happened, that if you had instead helped, for example, those people with those mortgages, it would have had a double effect. One is it would have helped the people with the mortgages, it would help keep people in their homes, it would have been kinder, and it would also have been better economics, because instead of paying what's now $21 trillion globally, and lots of other bells and whistles and subsidies along the way over these years. This is what's just available right now and is staying available. You would have paid probably $500 billion, so a very small 5% of that, literally to fix every single problematic mortgage at the time. And that would have been far cheaper, but that was not the decision. The decision was, let's write through these central banks, because they're theoretically independent of government policy, which is connected to banking policy, these blank, unlimited checks to these institutions, and there's still no limitation. The European Central Bank is continuing to buy corporate bonds now throughout Europe of the major countries and not the countries that are doing less well economically. So the whole design of this process has really been not to help Main Street. Yeah, they could have. It was an emergency powers clause in the Federal Reserve Act of 1913 that basically could have given the Fed latitude to say, look, yeah, we're going to give you this money, but you have to restructure this amount of loans, mortgages. You have to ultimately, as the years went on, help to cancel this amount of student debt. Or you have to basically lower small business loan money and make it more available to help grow the bottom part, the foundation part of the economy. Maybe the banks wouldn't have taken it. Now they won't take it. They wouldn't have taken it along the years. But I think at the time of the crisis, when they're looking at potentially closing, and potentially going bankrupt like a Bear Stearns or Lehman Brothers, that the banks that have remained standing in that situation might have accepted some of those restrictions or some of that diversion of money into the real economy. It wasn't an option. No one thought that could be a good idea. Because again, it was money sort of from the top of the system that has remained at the top of the system, and there wasn't really a thought to putting those sort of rules involved in that money. So there's a lot of things involved in why this has happened. A lot of it's just elite policy that's remained elite, and I think though there was an opportunity, and there probably will be again in the next emergency crisis, where if central bankers wanted to, they could put restrictions on what can happen to the money that they provide cheaply to the major banks. I doubt they'll do it. I hope they do it, and they should have last time.
So then how would you rate President Obama's bank bailout and his response to the 2008 financial crisis? After all, many Democrats praise it for leading to 8 years of decreasing unemployment and 8 years of stock market increases. So is the outcome of Obama's bank bailout good for the markets, good for workers, and good for banks?
It's good for markets and good for banks. And yes, the unemployment rate is lower, but that said, the way in which people are employed today is more tenuous. People have more jobs. People get less benefits. Wages have not increased barely at all with respect to inflation during a 10-year period, whereas the stock prices of banks have gone up by 3 or 4 times. So, yeah, it's good for some people, not for others. It was not just the policy of the Obama administration. It was the policy of the Federal Reserve under the Obama administration. And I think the fact that we haven't had a crisis during this period is simply because the central banks have colluded to such a mass extent in terms of the money they fabricated that they've plastered over potential problems by just throwing money at them. I mean, it's like if you go to a casino and you're sitting at a blackjack table and like you lose the first 7 hands, and the guy next to you says, "Yeah, no problem. Here's like 10 grand. Just keep playing." And you lose another 7. Here's another 10 grand. You lose another 7. It's like, well, here's 50. Then you have no incentive to really change. And like at some point, you'll start winning hands just because you've had all this money to help you do that. And then at some point, if you have to pay it back, there will be a real problem. So right now, the fact that this subsidy still exists and is still in place for banks have enabled the financial system to look like it's healthier. It hasn't lifted the level of wages anywhere near what it could have had it been used a different way. And I don't think that policy has been successful because what it has done is merely push that risk in a more consolidated, concentrated banking system into the future. There wasn't another financial crisis under Obama. There may be one under President Trump. There may be one if he goes in for another term or if some other Democrat or whomever takes that spot, because nothing has been fundamentally changed in the system, and it has and continues to be subsidized by central bank policy.